I think it needs to be the foundation, right? Just like you would do a risk score to figure out where a client's risk tolerance or ability to take risk and willingness to take risk would lie. We become way overly reliant on those type of things. We need to do the same thing on the behavioral side. And actually, I've worked with Jay at the Resilient Advisor quite a bit throughout my career. And one of the areas we've worked with him on was really kind of customizing a practice management approach around the behavioral aspects. And it started off very simple. We just want the client, our client, the advisor, to identify whether their client's more emotional about money or more logical. And that might seem on a spectrum too simplistic, but I always try to keep it as simple as possible. And the reason why is because that gives you a lot of information. If they're more emotional about money, and those are the ones that tend to stick out a little more, you're not going to educate them away from making bad decisions. You really have to adapt the portfolio to adhere to those emotions and that emotional state. And that's I think the big gap we have between practice and reality and pragmatism and academic literature is we still think that we can educate everyone by giving them reams of behavioral finance literature and telling them, hey, you've got some sort of heuristic that you're following. Let's try to change that. Look, we're innately loss averse as human beings. We're emotional. Money activates that reward center of the brain. The amygdala is super involved in terms of fight or flight response. And those are things that have been built for a long time in terms of our computing system in our brain. And so to all of a sudden think we can change that in people is over a span of a relationship in an advisory client perspective, I don't think is accurate. So what we try to do is figure out, are they more emotional, more logical? If they're more emotional, we try to cater the portfolio more to that emotional client, meaning we know they're going to have status quo bias. So they like to keep things the same, don't like a lot of change. So what I call hiding the diversification. We're going to use trend following. We're going to hide it in an ETF where all the changes happen within that structure or within a fund or a manager. They've got an aversion to ambiguity. They don't want to see things that they don't readily identify or recognize. And so, Kevin, this is great for like a portfolio for you, right? Being able to plug in an SMA or they see a bunch of names that they understand and have either bought their products or are used to, they will stick in that despite kind of what people think in terms about risk. They look at it a little differently. Then we know they're loss averse. So they'll hold on to positions for a lot longer than they should. So really having it in a managed program where those losses are taken, like trend following or some mechanism for buying and selling things, is super important. And to get that out away from them and really away from the advisor as fast as possible, in my opinion, is super helpful for that emotional type.